It's time for the Phil Ferguson Show.
Hello, everybody. This is Phil Ferguson, and of course, you are listening to The Phil Ferguson Show. This is show number 259, and I am so delighted that you are here. I just returned from Austin, Texas, had a fantastic time, and all the locals told me that highs in the low 80s and lows in the mid 60s. It's like that year-round, and never humidity. And it was just absolutely beautiful for our visit, and we had a couple days, my wife and I, to go see some tourist sites, including the Texas White House for Lyndon B. Johnson, and we went to the Oasis, looking over a lake, and many other fun sites. So I appreciate that. Shout out to Matt Dillahunty, who was kind enough to be our tour guide for a couple of days. He took some time off to spend with my wife and I, so I greatly appreciate that. Thank you, Matt. And, of course, Beth Presswood, his wife, they were both kind enough to allow us to stay at their house for a day or two and visit with them. So had a great time with that. Thank you very much for having me. And, of course, the Atheist Experience Show, which one of my favorite podcasts because it's different, it's unique in its nature, where random people just call up and argue, discuss religion. And I have to admit that I'm probably not the best suited type of person to be a host for that show, because I lack sometimes the patience to deal with things that I think, maybe I'm the one who's wrong here, but that someone has willfully convinced themselves of something that's just simply not true. I do like the good, nice religion argument one-on-one with a person, but my tolerance and amount of time I'll be willing to spend on one of those arguments has shrunk as I've aged and have done it for 20, 30, 40 years. So me being on the show once a year probably is a pretty good fit, because I think I would get burnt out. I definitely could not do it every week. I don't even know if doing it once a month would drive me crazy. So once a year, because I was on a year ago, once a year seems like a nice fit. And this time it seemed to go really well, and I was even a little bit better at keeping the snark and sarcasm to a minimum, because people are calling in an honest and genuine desire to discuss religion. And the two of the callers that stick out, well, I guess three. One, we had Will, who his arguments for the proof of Christianity were so bad that one has to consider the possibility that they were a troll. An atheist troll calling in to make arguments. The problem is that I've had those conversations in real life where people's arguments are so bad, it's just something that they believe, and they've never talked about it out loud, or if they have, everyone that they talk with believes what they believe, and you don't have to have good arguments. You just believe it, and you come up with the arguments later. These aren't the arguments that convinced you. They're the arguments you make thinking it might convince someone else. We also had someone call in from Urbana, Illinois, and I lived in Champaign-Urbana for many, many years, so that was a great joy for me. And later in the show, we had a caller, sorry, the name escapes me off the top of my head, that was going more into biblical quotes and prophecy, and the question I had for them, and they couldn't answer, of course, and they just went on to the next topic, was when writers of the New Testament write a story about Jesus or some other character, and that character fulfills a prophecy that may or may not actually be a prophecy in the Old Testament, the one thing that I always ask people, and no one has ever answered this, is did the writers of the New Testament have access to the books of the Old Testament? Because if I'm writing a new story about Batman, can I watch old Batman movies? Can I watch or read the old comics? Can I incorporate those things into my writing as a writer? Of course I can. So the idea that the writer was oblivious to the ancient texts, the Old Testament, and wrote a story about a character, and in the story, prophecy was fulfilled, is comical. What you have to do is find something. To get a prophecy, you have to find something that's very specific and show that it was predicted in advance, not after the events occurred. And even then, sometimes it's lucky guessing. The argument that Russell made during the show, and I've heard it many times before, if I ask a waiter for a medium rare steak and 10 minutes later he brings me a medium rare steak, is he fulfilling prophecy? No. He set about getting me a medium rare steak because that's what I asked for. So anyway, go check out the show, Atheist Experience. It was from April 29th, in case you missed it. And maybe, just maybe, I'll ask if I have permission to put the audio up as one of my future shows so that everyone can hear it. But go check that out. The Investing Skeptically part today is going to be a little short because I just rambled on for 5 minutes about being on the Atheist Experience. And the interview that's coming up with Jarrod James is quite lengthy, and it's a lot about technical aspects of the investment advisor world and the difference between a registered investment advisor, a broker, broker-dealer, insurance salesperson, the difference between suitability and a fiduciary. And if you're into that kind of technical stuff, I think you're going to really, really enjoy it. We really dig in and kind of pull back the curtain on some things and how the industry works. So you're going to do that. But before we get onto that, of course, the Investing Skeptically segment is from a listener's question. Basically, Phil, what is your current stock mix? And so by that, they mean stock index funds, because I don't do individual stocks. I do stock index funds. And so I am going to give you the names and the symbols of the index funds that I'm currently using to invest my money and the vast majority of all of my clients' monies. And I say vast majority because sometimes there's exceptions, because every portfolio that I build for clients is unique to their wants, needs, goals, desires, personal situation, age. And so this is not actual financial advice. Please don't consider anything to be financial advice. The show is meant to be educational, maybe on time to time entertaining. So, but here are some ideas of how you could invest your money and what percentages you could put in things. And these are just investment ideas. They may or may not work for you. They may or may not be right for you. Please do your own research. Please consult your own professional financial advisor. If you're not sure how to find one, you may contact me. My current minimum is $500,000, and I keep contemplating raising that, but I haven't yet officially. But $500,000. If you have under $500,000, you may still contact me and ask a question. Or if you wish, let me know, and we can probably set up a time to talk, maybe 30 minutes, and I can answer your questions and give you some ideas that maybe are more tailored to you. So my email is phil@polarisfinancialplanning.com. So what I'm going to give these ideas about stock index funds, we're going to ignore the cushion. So if you are 10, 12, 15 years from retirement or less, or in retirement, you have to have the cushion to protect you when the market goes down. The market does and will, from time to time, go down. You do not want to have 100% of your money in stock if you might need to take some of it out. This also doesn't apply to anything that you're saving up for. So if you're collecting money to buy a house, this does not apply. If you're saving money to buy a car, which maybe in this environment of low interest rates you want to get a loan on, but that's another show segment we've done before, this does not apply. This is for money that you're saving for long term. In previous episodes, I've talked about what to do with $3 or $10 or $50,000 or even $200,000. Well, today what I'm going to talk about is what to do with a bigger amount, 300, 500 or more, hundreds of thousands of dollars. So this is, something that not everybody is going to qualify for. It's something you aspire to, and it can be a little harder to do especially under $200,000 because some of these funds have minimums of at least $10,000 to get into. So if you open up an account at Vanguard, all of these are Admiral share class of funds, and I think all of them have a $10,000 minimum. So it would be hard to do this exact spread of funds if you have under $250,000. You can get close, but then you start to over tweak it. So this is for $300,000 or more. If you aren't sure what to do with $50,000 or $60,000 and you haven't heard the old shows, again, you can send me an email. I can send you an attachment, a document that has some ideas. Again, they may or may not be good ideas for you. It's not specific investment advice for you. But again, Phil at Polaris Financial Planning. So we're going to break the investments up into 3 categories. These are all stocks. And we're going to have international as the first category. And just for reference, I have that right now about 20, maybe 22. If you are feeling like you want to be a little more aggressive, I can even go to 25 or 28% of all of your stocks in international. So just a thought on that. Another category is real estate. And by that, I mean the Vanguard REIT fund. And that can be 5, maybe to 8, but no more than 10% of the stock portion of your portfolio. And since there's only one fund there, I'm going to give you that symbol now. That is VGSLX. VGSLX. That is the Vanguard REIT Index Fund, Real Estate Investment Trust Index Fund. And that can be anywhere from 5 to 10, probably target 8 to 9% of your stocks, not of your total portfolio. We're only talking about stocks today, so of your stocks. The international, like I said, 20 plus. If you're younger, I'm higher with the happier numbers. If you're closer to retirement, something around 20 or 22% is probably more where I'm leaning for you. And the part that's in international, I'm going to break that up into 2 different funds. The majority of the money should be in VTIAX. That's the Vanguard Total International Stock Fund. So that should be 75 to 80% of the international money. The other 20 to 25, we're going to put in the Emerging Market Fund. That is VEMAX, Vanguard Emerging Market Fund, VEMAX. The Emerging Market Fund contains stocks that are also within the Total International Stock Fund. So what you're doing is putting an extra bit of leverage on international or on the emerging markets. It is the most volatile thing in this list of investments, and in some years can make a lot of money. The 12 months ending March 31st, it happened to go up 21%, whereas the total market is, 15, give or take. Sometimes it can go down an awful lot. You want to make sure that that is no more than 25% of your international and no more than 5% at most of your stock investments, maybe even no more than 5% of your total portfolio. So if you're building your cushion, keep an eye on the international and keep an eye on the emerging markets to make sure they don't get a little carried away. So if you happen to have a couple of years where U.S. stocks don't do particularly well, but the international does, you can always sell some of the international and put it back in domestic. Or if you're growing, getting closer to retirement, you build your cushion. And before I get into the domestic U.S. stock market part of this, keep in mind that if you're listening to this from another country, this may not apply to you. And one of the things that's a big problem is that if you want to rebalance and you're in a taxable account, you have to be very, very careful about the tax consequences. So you may want to consult with your tax expert, an enrolled agent, or a CPA, someone that can help you go through that math if you have any trouble with that. As an example, I had someone hire me a couple of years ago, and they happen to work for a high-tech company, which I'm not going to say, and they happen to have half of their money was in the stock of that high-tech company. So if they lost their job, if something weird happened to that high-tech company, and things like that happen from time to time, but no reason to believe that their specific company was going to have any trouble. But if it did, you could be in a position where you lose not only your job, but half of your retirement savings. So what we did in their case is we had to look very carefully at all their investments, because it was all in a taxable account, and figure out which items to sell in what order. And we started doing that in 2015. We did some more in 16, some more in 17. We did some more in 18. And unfortunately for them, they can't catch a break. The stock that they own kept going up. So as we sold more, it became worth more. It sold more, it became worth more. But over 4 years of gradual effort, we have reduced their position from 50% to now under 7% is in that one stock. And of course, each year we've created tax consequences, significant tax consequences, because we're talking about moving millions of dollars in this case, or more than $1 million over a couple of years. So it's something you have to do very carefully and understand what you're doing and why you're doing it. All right, enough of that. In the U.S. part, what I call the U.S. market matrix, I use 6 different funds, and I'm going to go over them here. And these 6 funds roughly equal the entire total U.S. stock market if they're in what I call market neutral positions, where if you buy these 6 funds in the appropriate portions, it will pretty much equal the total stock market index. The reason I use these 6 funds is because sometimes 1 or 2 segments do better, and sometimes 1 or 2 segments do worse. So that is a way to continually buy low if you're adding money, and to sell high if you are building your cushion or already in retirement. And my regular listeners know we not only do this in stocks, but in bonds as well. That's one of the reasons you want to have multiple different investments, because while they may all tend to make 10%, they're all stock investments in this case, they don't necessarily do that in any given year. The extremes for the last year, again, ending March 31st, is the Vanguard Large Cap Growth Fund made 18%, and the Vanguard Small Cap Value Fund made 7.3%. So a difference of more than 10% in just 12 months. So if you're in retirement or you're a few years away from retirement and you're trying to build the cushion, I'm inclined to sell more from the fund that went up 18% and not sell from the one that went up 7%. If I'm adding new money and not worried about the cushion yet, I'm more inclined to add money to what only made 7% and not add money to what made 18%. Of course, from time to time, I may rebalance a portfolio. And again, that depends on the size of the portfolio and how far out of whack it gets. I'm not worried about a 1 or 2 or 3% shift. We don't want to micromanage this, because you're going to spend effort. You might have trading costs, and you might have tax consequences, and then still not be right. So don't get too obsessive with this, but these are just general ideas. So in the U.S. stock market, give or take, historically, large cap is 65 to 75% of the total market. Right now, it's closer to 75%. So if you put 75% of your U.S. money in the S&P 500, you're well on your way to being close to a market neutral position. I, however, am pushing down to 60% or below for large cap, not the 75. So the bigger the S&P 500 gets, the bigger the large cap gets in relationship to small cap, the less of it I want to own. So right now I'm about 60%, maybe even 57 or 58% in large cap. And if you're at 62 and my target is 58, you're fine. It's a couple percentage points. Don't freak out about it. But if you add money, don't add it to the large stuff, add it to the small stuff. If you're at 55% and I'm suggesting 58 to 60, fine. When you add new money, maybe you can add it to large cap. The S&P 500 I break down into 2 positions, the Vanguard Large Cap Growth and the Vanguard Large Cap Value. You can have them about equal, or right now I'm running about 10% more of the money in value versus growth. So as a part of your total U.S. stock market, you might have, say, 28% in large growth and 30% in large value. Again, you don't have to be exactly these numbers. I am a little worried about how well large cap growth has done compared to other segments over the last 5 years, maybe even 9 years. 10 years, they're all about the same because we had the 2008 correction. But the large cap growth has done better, which is great if you've had a lot of money there. And we still have, 26 to 28 to 30% there. So it's not like we're running away from it. We just don't want to overdo it. You don't want to have 40%, or I recently talked to somebody that showed me the funds that they had, and all of their stocks, they had 95% in large cap and 75% of all of their money in large cap growth. And I'm looking at 30% or less. So if you have all your money in large cap growth and something goes against the really big stocks that have won and made the most money over the last 5 to 10 years, you could get hit more significantly than someone that is a little more diversified. So the large cap growth, VIGAX, and the large cap value, VVIAX. The next 4 positions in the U.S. part are mid cap growth and value, small cap growth and value, all 4 of these, the Admiral share class. So their expense ratios are around 0.07%. Average stock fund is going to be between 1.2 and 1.5 as a published expense ratio. And then there's other expenses that you pay that aren't part of the expense ratio. And that's all assuming you're not paying loads or 12B1 fees. So these 4 funds are the following: VMGMX, VMVAX, VSGAX, VSIAX. Again, mid-cap growth and value, small-cap growth and value. All of them are the Admiral shares. If you didn't catch all the letters, send me an email, phil@polarisfinancialplanning.com. I can send you a short list. You can also look them up on Vanguard. This is not incredibly difficult for you to find out on your own. Each of those funds, I have between 10 and 11, maybe 12% of the U.S. part of your portfolio each. Sometimes in the past, they're different than what I'm doing right now, but their 3-year and 5-year and even 10-year performance, they're all within 1% or 2% of each other. If any one of them I was going to lean a little extra heavy on, if you had that last $4,000 or $5,000, you don't know where to put it, that would be the Vanguard Small Cap Value, VSIAX, because it was the one that returned 7.3% in the last 12 months. Everything else did considerably better. So you're buying low with the idea that with regression to the mean, all of these will end up eventually making about 10 plus or minus percent per year in the long run. Now, keep in mind, in the short run, all of these together could lose 25, 30, 40, 50%. So again, this is long-term strategies, long-term ideas. If you need the money for the next 1, 3, 5 years, this does not apply. If you're getting close to retirement, this applies, but you still need to have money in the cushion, which is other segments I've talked about. Anywho, I thought this was going to be a quick little 5-minute thing. We're going to have a little interlude, and then we'll go into our interview.
As you get older, you just ditch certain things as you get older, and it's a pleasure to do, right? I mean, for example, right, religion is a very good example. I wouldn't be a very spiritual man, right? I don't believe in God, right? Still Catholic. Because there's nothing you can do when you're Catholic. Once you've started Catholic, frankly, there's no real way to stop being Catholic. Even not believing in God isn't regarded as sufficient reason to get out of the Catholic Church. You'd think it'd be fairly fundamental to the whole thing, but no, Catholicism, the stickiest, most adhesive religion in the world. There's no website you can deregister online. You can't put up your membership card in front of a priest and go, "Feck ya, I'm out of here," and walk away. You could join the Taliban. You'd merely be regarded as a bad Catholic. I'm presuming a large chunk of you probably were raised Protestant. Give me a cheer if you had any Protestant upbringing at all. A fair few of you, right? Now, when you do the wafer thing, right, and take the hoops or whatever thing, it represents the body of Christ. It's a metaphor, it's a symbol of the body of Christ. Oh, not when you're Catholic. When you're Catholic, it actually is the body of Christ. You're supposed to actually believe that it turns into the flesh of Christ in your mouth. Nobody fully explained this to me as a child. I would have spotted the flaw relatively quickly in that. I would have gone, hang on, I might be 8, but I've eaten enough burgers, chicken McNuggets, right? Fish fingers and rashers to know there is no animal flesh in the world that jams itself to the roof of your mouth and hoovers all of the moisture out of your body until you're looking at your mother going, can I take it down with my finger? And look at the roof of my mouth. And she's going, do not take it down with your finger. It's the body of Christ. Leave it where it is. And making a show of me in the church. Desiccating me from the entire earth. Desiccating, by the way.
All right, everybody, welcome back. This is Phil Ferguson, and of course, this is the Phil Ferguson Show. Today, we're going to get a little technical. We're going to talk about the industry and things behind the scenes. And for those of you who really get into this kind of stuff, you're going to love this show. With me today, I have Jarrod James, and he works at RIA Compliance Consultants. How are you, Jarrod?
I'm doing great, Phil. Thanks for having me on your show today.
And as I'm looking at the email, it says you're vice president, huh? So
I am. I've worked at RIA Compliance Consultants now for over a decade. I think I started working here about 2005. I'm a senior compliance consultant and also have the title of vice president. So we work primarily, I'd say almost exclusively with investment advisors, but we also see quite a bit of broker-dealers, hence the name of our firm, RIA, stands for Registered Investment Advisor Compliance Consultants.
Yeah, that makes sense. And I didn't even think about this before, but since it popped into my head, full disclosure for my listeners, I like to do this whenever there's a potential conflict. I pay money to RIA Compliance Consultants for them to help me with my compliance with the government. And of course, Jarrod, in a way, inadvertently gets paid by someone like me for doing business. So I just wanted to make sure we had that out there for public information.
That's exactly right. I've been working with Phil and Polaris Financial Planning for Phil? I think it's since 2015 or so. And he's hired me. I help him with some regulatory filings and just or he asks questions and I try to help answer and guide him through the regulatory maze of investment advisor compliance.
Well, it's one of those things that I started this as an ignorant fool. I never worked for any big company. So when I went to register the first time, I get these forms and I'm just like, what the hell am I reading? I mean, I had to have an open search page in a dictionary to try to figure out what the questions were even being asked of me. I mean, if you're in the industry and you've done this like you have for a decade, and I have now been an advisor for over 2 decades, it makes sense and it's not that hard, but you just start from scratch. I remember that first time I filled out the forms and I had to call my regulatory official in the state of Illinois, who was marvelous, spent an inappropriate large amount of time with me to answer my questions, but it gets complicated. What kind of questions do you think trip up new advisors?
Oh man, we see all kinds of questions, and I think the kind of a recurring, I don't know if it's a specific question, but a recurring issue that I see, especially with a firm like yours, or smaller firm, one-man shop, maybe you've got another advisor or a couple advisors, but small staff. What I tell people is that your compliance programs, you still need to have, the full set of compliance policies and procedures. A lot of people will say, well, do I really need that? Or how does that apply to me? And all firms, regardless of their size, still need to have a dedicated set of what we call written compliance policies and procedures. All firms, regardless of their size, need to have what's called a Form ADV Part 2 disclosure brochure. all firms, regardless of their size, need to make certain regulatory filings with, whether it's the SEC or the individual state regulators. So there's only really one type of investment advisor registration. Now there's other, financial professionals out there. I'm sure we'll get into as we progress in our discussion today. That could be, an insurance agent or broker dealer. But when we're talking specific about investment advisor, there's just one type of investment advisor. You get registered as an investment advisor. Pretty much all the rules apply. The real trick is figuring out how a particular rule applies to your firm given your business practices. So that's where we'll start talking to my clients about their business model, right? The types of investment strategies they might want to have, the types of different arrangements they'll have with custodians, the types of fees they want to charge. And so while everyone has kind of a set of rules they got to follow, their actual firm policies, procedures are really going to depend on, again, their business model, what they want to do. So that's where I'll come in and talk to them about, different registration requirements at the individual state levels, different disclosure obligations depending on what services they're providing. Another big one is the different business arrangements. So my firm sees all kinds of different arrangements. We'll see guys that are running hedge funds, running mutual funds. We'll see guys that, we'll work with larger investment advisor firms that have an affiliated broker dealer, an affiliated bank, affiliated credit union, whatever. Obviously, those types of arrangements are going to be a lot more complicated than, say, a guy that just does financial planning for a fee. But a lot of the business model stuff we'll flesh out, detail that out, and then, just various questions come up. Another big question we get is advertising. What can we say to our clients? What can we say to the public? So we spend quite a bit of time talking about that, trying to train our clients up. In the investment advisor community, you're not selling cars, right? You can't just say whatever the heck you want. You got to be careful about what you say and how you present it, because you're dealing with clients' money, and you can't guarantee a particular investment performance. You can't guarantee a specific return when you're managing money, and so you want to be careful about that type of wording. So we see all kinds of questions, and so you can cut me off here because I just will start talking and talking.
That's part
of what even your first question was.
That's okay. That's part of the beauty of it. One thing that cracks me up, and then I want to get into some definitions, is that I have to have a complaint folder. And thankfully it's empty, but even without complaints, you must maintain a complaint folder. And it's in the rules. It doesn't have to make sense. It's just a rule. For clarification, RIA, Registered Investment Advisor, that is the title given to a company. And if I get any of this wrong, which could happen, correct me. But I myself, Phil Ferguson, I am not an RIA. I am a RIA, Registered Investment Advisor, RIA. Does that sound right?
Well, that's your company is the RIA firm. So most people will set up a corporation, an LLC, and that's right. That company is the RIA, Registered Investment Advisor.
I am an investment advisor representative. That's what I meant to say.
Exactly. So the individual people, and there's actually, honestly, the barriers of entry are fairly easy. There's basically one exam you got to take as an investment advisor representative. It's called the Series 65 exam. There are other people out there that might have the Certified Financial Planner designation or Chartered Financial Analyst. There's a couple of designations out there that regulators will accept in lieu of the Series 65 exam. But essentially, you pass that test, and you can be a registered investment advisor representative of an investment advisor firm.
Yeah, and it's one of the things that people ask me all the time, and I want to hear your thought on it because I've already expressed this before, but if someone says they're a financial planner or they're a retirement planner or they're a financial representative, those words, those titles, what meaning do they have under the law? Under
the law, they don't have a lot of meaning, and I think that the looseness of titles within the industry, and this is the case when you're watching a commercial, whether it be, Charles Schwab advertising or, Bank of America, some of the big companies, when the word advisor kind of gets thrown around a lot. Financial planner is not a regulatory term. Financial advisor is not a regulatory term. So within the industry, we've created different titles, and it starts to kind of muddy the waters on who a client, who an investor is really working with. And the key thing is that an investment advisor, that is a defined term. Like, you register as an investment advisor. The other one is a broker-dealer. You register as a broker-dealer. And again, that would be at the firm level. And then an individual representative of a broker-dealer is usually referred to as a registered representative or a securities agent. That doesn't sound great from a marketing perspective. I want to go walk with my registered representative. So a lot of broker-dealers will throw that term planner or advisor in. And honestly, from my perspective, they kind of get away with it even if that person's not also an investment advisor. There's a lot of firms out there, a lot of individuals that are registered as both. Phil, correct me if I'm wrong, but I don't think you are. You're just an investment advisor representative. You're not with a broker-dealer. Isn't that right?
I am not formally associated or linked to or tied to a broker-dealer, but I do use TD Ameritrade, which is a broker-dealer, as my qualified custodian.
And so the way that works then is a guy like Phil is going to be what I would call a fee-based or a fee-only. So an investment advisor, the best way I can explain kind of the difference is, like, if I'm going to go and talk to a financial professional, I really am going to ask, how are you getting compensated? How do you get paid for your advice? An investment advisor is going to charge the client a fee. It could be a planning fee, it could be a fixed fee, an hourly fee. Most common, like if you're going to have a brokerage account at TD Ameritrade that the investment advisor is going to manage, you're probably going to charge, say, 1% of the total assets under management. And that's what we call an asset management fee. Whereas a broker-dealer, if you set up what's called kind of a broker-dealer brokerage account, representatives of broker-dealers get paid commissions. So they get paid every time you make a transaction in your brokerage account. And there's a whole slew of regulatory regime under that. But the key difference is, this is what I tell people, is, are you getting charged a commission from your broker-dealer, or are you getting charged a fee from your investment advisor?
Now, if you were just to talk to an individual person and they say, I have a financial advisor, whatever that word means, and I don't pay them anything, what do you think?
If you're not paying them anything, I would say, well, they're clearly getting paid somehow. They're probably getting paid a commission, and you just don't realize it. Also, in kind of the commission world, they might put you into a pool of mutual funds, and those mutual funds might pay what's called a load or a 12B1 fee. In my mind, those are expenses charged to the person that owns the mutual fund, but those get paid back to the representative on that account that's been selling those funds.
And I just want to jump in.
Yeah,
the load, if I understand correctly, by law can be no higher than 8.5% on the front. But some mutual funds have a continuous load, and some will have a back-end load. And then the 12B1 fee was originally designed to pay the advisor. And once the fund grew to a bigger and bigger size, the other expense ratios would go down. It just has never worked out that way.
Yeah, I mean, that's right. I think you'll hear various different share types, A shares, B shares, C shares. There's all kinds of different. Those are essentially telling you if the load, which again, to me is just a fancy word for a commission. It's that front end load. You could have a back end load where we use the term advisor loosely. I'd say it's the registered representative of broker-dealer, because if you're only an investment advisor, and this is a key thing, this is one of the what I like about working with an investment advisor. An investment advisor is not going to get paid these commissions, these loads, these fees, because they can only go to someone that's registered with a broker-dealer. And so if you're working with an investment advisor and that investment advisor puts you into an A share or a B share or a higher expense, a higher cost mutual fund, he or she is not going to get a piece of that. He's just going to charge you your 1% management fee. And that kind of by definition will reduce his incentive to put you into those types of funds, and therefore kind of look out for your best interest to just be looking for the lowest cost share class, mutual fund.
Right.
Whereas a registered rep of a broker-dealer, he's incentivized. He's going to look, how am I going to get paid? I'm going to look at these funds. And also a lot of these larger broker-dealers, they have their own mutual funds. They call those proprietary mutual funds, where they might have other incentives. Maybe it's a bonus, maybe it's a higher payout to push or recommend their own proprietary products and therefore get more money. And in the broker-dealer world, a lot of that stuff is not fully disclosed out. It's not fully detailed out, and it's a little bit hidden. Technically speaking, an investment advisor, and we'll probably get to this, investment advisor is considered by law a fiduciary, is supposed to, by law, disclose that stuff to the underlying client and be very transparent and clear about how the investment advisor is making his or her money.
And one of the things that you brought up, I've talked about this on my show before, but I want to make sure that I'm clear and I have this right. If you hire somebody or if you work with somebody, I don't want to say you hire them because you're not paying them, and I don't want to use a specific company, but let's say it's Merrill Jones. And you hire someone from Merrill Jones and they don't charge you anything and they put you in a mutual fund. And what I tell people is to look at the very, very end of the name of the mutual fund. And there's a letter hanging out there, an A or a B or a T or a Z or whatever. That's probably some kind of load, which is probably meaning you're paying them or they're getting paid via commissions. Does all that sound right?
That sounds right. And just because your account's not getting hit or debited right away, rest assured your advisor, again, registered rep of that broker-dealer, is going to get paid by that mutual fund sponsor company. It might be the company he works for is affiliated with. It might be an unaffiliated company. But that mutual fund company is paying that load, or the ongoing, I think you started to mention the ongoing, we call them trails, 12B1 fees, which is more of, that representative is going to get paid from the mutual fund company itself. So essentially indirectly from the owner, or i.e. the client, but the owner of the mutual fund. It all comes out of the mutual fund itself. The client's just not paying it directly.
Sure. So if somebody works at this fictional company that I've made up, has nothing to do with reality, called Merrill Jones, they work for Merrill Jones. They're paid by Merrill Jones. The broker-dealer is Merrill Jones. And then if they put you in Merrill Jones funds, which you use the same word I use, and I always like when I hear that because sometimes I get things confused. It's complicated. You call that a proprietary fund, and they want to move to a new broker-dealer. Will they face any problems moving that proprietary fund?
They could. I mean, it always depends on kind of the relationship. A firm like Merrill Jones, another thing to think about is your representative an employee of Merrill Jones or an independent contractor? So that could be issue one. Like, you might build a great relationship with your representative of Merrill Jones. He or she decides to leave, and Merrill Jones doesn't let you go with your representative. But let's assume Merrill Jones does let you leave, and then you go with your Merrill Jones representative, and then you could. If the new custodian or the new broker-dealer of your representative, or let's just say you decide to fire the guy and trying to leave, you could pay extra costs and fees to move your funds out of that account. So there's always kind of details, and of course I'm a compliance guy, so I see all different kinds of situations and arrangements that oftentimes a simple question can come up with, quite a few different scenarios. But that's actually a very important thing to understand and know, is what happens if I want to close this account? What happens if I don't like the representative? What happens if my representative gets fired? Those are questions that most investors probably don't answer or don't ask, but the answers could have a pretty significant impact on the overall management and just where your accounts ultimately held.
Just had another question pop into my head. A few weeks ago, I did a very comprehensive, detailed examination of Acorns and the contract that you have to agree to put an account there. And I had some questions, and I actually contacted Acorns, and they confirmed that they hold your investments for you in their name. So if Phil Ferguson opens an account, the account is in Acorn's name, and they just tell me what I own versus the account being in my name. Any thoughts on that?
Well, generally speaking, so one of the things that regulators, so if a client came to me and said, can I do that? Can I essentially have a pooled account, omnibus account, whatever you want to call it? Again, we look at a lot of details. Regulators are not going to necessarily prohibit that, but they would require more, they'd have more regulatory requirements. So that firm might be subject to more external audits or hiring an accounting firm to come in. Generally speaking, though, right? So in other words, my point there is there's certain regulatory standards that a firm could hit, and from a regulatory perspective, they'd be okay. If I was, again, I'm biased. I work with investment advisors, and I'm kind of biased from the standpoint. I like the situation that you use, Phil, where you've mentioned TD Ameritrade. Correct me if I'm wrong, but they're independent from you. You're not an employee of theirs.
Correct.
You're not registered with them. You're not. You don't have any sort of contractual obligation to keep using them.
Correct.
That actually helps the client, because they don't have, an obligation to really help you out. So in other words, if you were going to try to figure out a way to defraud your clients, they're independent from you. They're an independent custodian, and they have a relationship with the client. They might have, protocols behind the scenes, namely just the fact that they're separate from you, and the client can always call them directly. You're going to hold the client's money in an individually managed account, which means that the client has their name on the account. The money is segregated at TD Ameritrade, again, which is independent from you, and they're going to get account statements that are specific to their holdings, their money, their cash, their investments. And then if they had any sort of suspicion that their investment advisor was up to no good, they could call TD Ameritrade, right? Every statement, every statement's going to have a contact number, customer service. So it's just a natural check and balance.
Yeah.
That if I'm talking to my grandparents and telling them where I think they should put their money, I'm going to say you're probably best off working with a fee-based investment advisor that's using an unaffiliated independent custodian, because that's a natural check and balance. Anytime you start writing checks to fund your account, again, not that you can't do it, so I'm not trying to say like it's automatically bad, but anytime you start writing checks to the same company that employs your advisor or your representative, you want to make sure you really do your due diligence and understand where that money's going, and that company's got the
Right.
Is itself a qualified custodian, or is itself subject to certain audits? So
it's always
again,
one of those...
my long-winded answer to your question there.
One of the things that I tell people, matter of fact, for my listeners, since it came up as a topic, if you hire Phil in Polaris, you are free to contact TD Ameritrade at any time and say, Phil's an asshole. They'll have you fill out a form, and I won't see your accounts anymore. They just, poof, disappear. From my view. They're still at TD Ameritrade. They still have your name. You never lose the money. Well, I mean, the market can go down, but you never lose control and visibility and access. It's your account, and it's not muddled or mixed with anything else, which scares the crap out of me. The proprietary funds, and like you were talking about, having your advisor work for the company is a problem for me. And then having your money then in proprietary funds, not necessarily bad. It just, I don't know, just creates some possibilities for problems. Another question, do you do anything with people who sell insurance or annuities or things like that?
I do. Well, we work with, we don't work with like insurance. We don't do insurance compliance work, but we certainly have lots of our clients that are investment advisors. If I was to break down my kind of client base, I'd say about 50% of our clients are I'll use the word fee only. They're RIA only. They're not with a broker-dealer. They don't sell insurance. All they do is provide advice, might manage accounts, might do financial planning, but they're providing advice and charging a fee. Then I'd say the other half of our clients are registered with a broker-dealer, and almost all of those guys that are registered with a broker-dealer are going to have an insurance license. They're going to be selling annuities. They're going to be selling whatever type of life insurance that a client might need. My guys that are kind of RA only, not affiliated with the broker-dealer at all, I'd say it's a smaller percentage, but there's still a good number of those guys that'll at least keep their insurance license active. It's usually a pretty small part of their business, but if a client comes in and really needs an insurance product or needs an annuity, they at least have a license, and they could, if they want to, sell that through them. Then I've got certainly some guys that have been primarily insurance guys, and forever they've really done the indexed annuity business, and then they're starting to figure out, I should go out and get my Series 65 and become an investment advisor as well. That way I can provide advice not just on the insurance side, but then also could charge a fee on the investment advisor side. So I guess the answer to your question is yes, we see that, but I don't do specific insurance compliance work, if that makes sense.
And one of the things we talked about, and I think we kind of answered it, but I want to dig into it specifically. What is the difference between fee only and fee based?
Some of that is just semantics. So one thing to keep in mind is neither of those are even regulatory defined terms.
Right.
But those are things that people like to use from a marketing perspective. Obviously, the gist of this discussion has led probably anyone to think, listening, that fee only, fee based, rather than getting commissions and being incentivized by trails and proprietary. Not that that's illegal or wrong or necessarily even bad. It's just different, and it's ripe with more conflicts than someone that is fee only, that only gets paid by the client, and it's very transparent, very clear. So a lot of firms like to tout that, right? I got a lot of clients that like to tout the fact that they're fee only. They like to say like to tout that I am a fiduciary. The investment advisor is a fiduciary and is going to act in the client's best interest. So if you're going to say you're fee only, that's actually a high standard. You're not required to say you're fee only, but if you're going to, regulators, and quite honestly the public, will hold you to that. Prove that up. So if I've got a client that is primarily fee only, but holds their insurance license, and in the past year has sold maybe just 5 insurance products but got a commission, I got to tell them, you're not fee only. You sold a commission. You earned a commission, because anytime you're getting a commission from either an insurance company or that brokerage company to sell securities products, you're not fee only. Those are commissions. Fee-based is kind of the in-between, where somebody might be fee-based in that they are providing investment advice for a fee, but they're still got the registrations for insurance, and it's just not as high a standard as fee only. And that's how kind of the regulators, I think, have looked at it. there's nothing like formal or official to put in writing.
Right.
But they'll say a fee-based guy is probably a guy that primarily charges fees, but he still might sell an insurance product and get that commission.
Now here's a question for you. And I've had some clients come and talk to me and either show me their statements from other places or even eventually hire me. And they work with someone that is at a broker-dealer, and they pay a wrap fee, whether it's a percentage or a flat amount, and then they get the impression somehow that because they're paying this wrap fee, the representative, I'll call them, can't make any other commissions. What do you think about that?
Yeah, that. I might argue they probably shouldn't make any other commissions, but it's not necessarily prohibited. So a wrap fee, and there's a lot of confusion out there. That word, even amongst my clients, people don't really understand what the heck wrap fee means. But that is a regulatory term. And technically speaking, a wrap fee program is going to be a program where the client is paying one fee that's going to include investment management or investment advisory services. But then it's also going to cover that one fee you're paying is also going to cover all of the ticket charges, all of the trades in your account. The opposite being in most investment advisory programs, we'll just call it investment management programs, is that those two things would be separated out. So if you looked at your brokerage statement, your account statement, you'd see one line item for, say, 50 basis points this month or this quarter were charged for an investment management fee. And then separately, every time there was a trade done, your account got charged a ticket charge or commission, whatever phrase you like to use. Whereas if you're getting a wrap fee program, there would be just one fee, and there wouldn't be kind of that second line item showing every ticket charge that got hit because you're paying one wrap fee. But to your question, a lot of these wrap fee programs are certainly done with guys that are registered both as an investment advisor and a representative of broker-dealer. And just because it's wrap fee doesn't mean it couldn't have proprietary funds or load-paying mutual funds or 12B1 paying mutual funds. And if your particular representative is registered with the broker-dealer, he's registered in a way where he could receive those commissions, those 12B1 fees, those loads, whatever. So it certainly could happen. Right now, this year, just the last couple months, the SEC has really they've started. Actually, it's called a self-disclosure, self-reporting initiative, and they've really been hitting on essentially these duly registered firms. Again, duly registered meaning you're an investment advisor and broker-dealer. And if that type of firm, that type of representative was getting both a fee plus ongoing loads, trails, commissions, whatever you want to lump, and that rep did not give explicit, detailed disclosures, they're looking for firms to self-report that issue, and in the last couple of years, they have fined some firms pretty heavily for that, mainly for the thinking being they've misled clients on the exact type of compensation and the full just disclosure of how they were making money.
Yeah, because I've seen people come to me and they're paying 1% or 1.5% or even 2% for a wrap fee, and they had. I don't know how they got the impression. I got some ideas. But they got the impression that once they paid that wrap fee, that nothing else would ever come out of their account, but yet they're put into load funds that can pay 3%, 5%, up to 8.5% commission to the salesperson, and even other products like a private placement REIT or master limited partnerships where the salesperson can make 10%, 15% commission. Does that all sound possible?
Yes. It does sound possible. Okay. And what should happen is the regulatory directive on that would be, again, keep in mind, all wrap fee means is you paid your management fee, say 1%, 2%, and that includes all your ticket charges, all your every time you make a trade, Just the fee to make that trade is covered. It's not, you're not
Right.
billed extra.
So you're not paying
But
that.
any sort of commissions, there could be lots of other expenses still in that account, And I think what happens is probably some financial professionals that are touting the program, explaining the program, they'll get a little loose with their language, and they might say, hey, this everything's included, But that's not really the case.
Yeah.
You read the details, you find out, there's a fee schedule for other stuff.
Yeah, and who reads a 46-page disclosure document? I mean, it's just, maybe you should,
right.
but it's not, one of those things. A couple other terms I want to go over, and the first one we'll start with the simple one. The word suitability. What does that mean, and what is the enforcement around that term?
Well, suitability, I think probably if I'm trying to explain it in the most plain English terms, is simply that a financial professional needs to gather sufficient information to make sure that his or her investment recommendation is suitable or appropriate for the client based off, various factors about that client.
And is that a high bar to jump over, or is that something pretty easy to do and almost no one ever has a problem with it?
It's a lower bar. So the way I like to illustrate it is broker dealers are going to use that term suitability a lot more because the broker dealer regulatory environment focuses on the word suitable. Let me explain it this way. Whereas investment advisors are held to a higher standard. You're held to a fiduciary standard. Broker dealers are not held to a fiduciary standard. And this might be where you're going, Phil. I might be jumping the gun.
No.
I think it's the best way to explain it.
It is. And before you finish this explanation,
yes, go ahead.
How about someone who is not a broker or a broker dealer and just works for an insurance company and recommends annuities? Are they fiduciaries also?
No, they are not. And so when you compare it, that suitability to fiduciary basically says, hey, this investment might be suitable, right? But is it in the client's best interest? Like, what's the most appropriate? What's in the best interest of the client? Especially in the annuity world, if you're an insurance guy, those standards are probably even lower than the broker-dealer world. It's just not as heavily regulated. Broker-dealers are going to be probably challenged a lot more on their investment recommendations than an insurance guy, especially fixed insurance. Now, you start dealing with variable annuity. Anytime you hear the word variable, that means it's kind of a hybrid product. It's both insurance and securities. And so that's where you've got to at least be with the broker-dealer. So when we start talking variable annuities, variable insurance, and just straight broker-dealer commission-based investment recommendations, suitability, showing that the investment was appropriate based off the client's basic, investment objectives, different parameters, but it's not as high of a duty as a fiduciary duty showing that this investment was in the best interests of the client. And of course, that's what an investment advisor would be held to.
Now, as you know, there was the Department of Labor new fiduciary rule, and it looks like that's DOA now. Is that correct?
Yeah. So one thing to think about in this, quite honestly, this gets into kind of, there's politics everywhere. This is somewhat the politics of the investment world, the financial professional world, right? So investment advisors, a guy like Phil, whether he likes it or not, he's a fiduciary. Since the 1960s, investment advisors have been held to a fiduciary standard. And when it comes to the DOL, Department of Labor, we're talking about retirement accounts, retirement plan accounts, 401k accounts, individual retirement accounts. Forever, investment advisors, investment managers that charge a fee on those types have also been held to a fiduciary standard under DOL. DOL is separate from Securities and Exchange Commission. So an investment advisor, again, a guy like yourself, Phil, whether you want to or not, you are a fiduciary. You're held to that fiduciary standard. But as we've talked about here, just the terms and different business models, there's a whole segment of the financial consulting industry, the broker-dealer world, the insurance agent world. They are not currently held to a fiduciary standard. They're not held to it by FINRA as a regulatory body. They're not held to it by the SEC, and they're currently not held to it by the DOL. So the DOL, a couple years ago, came out with a rule with the number one thing trying to expand that definition of who's a fiduciary to basically include any financial professional, whether you're a fee-based or fee-only investment advisor, or whether you're a commission-based insurance agent or a commission-based broker-dealer. And so that came out, and as you could probably imagine, that could have huge repercussions. Just the difference, think about it from a civil liability standard, the suitability being much lower than fiduciary. All these things we've talked about as far as extra compensation, hidden fees, proprietary products. Those are things that a fiduciary needs to ultimately try to root out or at least disclose out. So you'd have a whole segment of the industry that would have a very hard time doing that, rooting it out, and probably wouldn't want to disclose it out. So they kind of fought that rule, and essentially that rule right now is pretty much dead. But the way I explain it to my clients is it's dead from the standpoint of broker-dealers and insurance agents have essentially gotten a pass right now. They're not held to that fiduciary standard. Just in the last week or so, the SEC has tried to pick up the ball and make some, at least propose a rule that's out for kind of discussion right now. It's very preliminary, but trying to extend this concept of a fiduciary to that broker-dealer world. Now when I say politically, when you start looking at just kind of lobbying groups, you'll see right away, right, the Investment Advisor Association, this big SEC registered investment advisor lobbying group. And then you've got people like the CFP board and the Financial Planning Association. Those are very fee-based, investment advisor-based fiduciary standard. They're all for the expansion of those fiduciary definitions and fiduciary rules. The broker-dealer world, the insurance world, you can rest assured that they're going to try to fight any sort of, initiative to try to expand the definition of fiduciary.
It's one of the things that, for me, I'm it's not really conflicted, but I have two sides of my business or two sides of my mind, I guess I'll say it. I want the fiduciary rule to apply not only to retirement accounts, but to every account. Anytime someone gives financial advice for a fee, they should be required to be a fiduciary because I think it's in the best interest of the people. The part of me that has a problem with that is that I lose a really big part of my competitive edge. So in a weird way, by this rule failing, I keep my competitive advantage over the vast majority of the industry, although I'd rather make a little less and lose my competitive advantage if people ended up having better advice, I guess. Does that make sense?
That totally makes sense, and that's exactly what I was saying earlier when we were talking about the word fee only. And I was saying, I've got lots of clients that, and essentially if you think about it, Investment Advisor Association, people like Financial Planning Association, CFP, the Certified Financial Planner Board of Standards, they're owning it. Like you're saying, we're just going to own it. We are a fiduciary. We're going to explain what that means. We're going to do our best. We're going to really act in our clients' best interests, and we're going to try to model that and use it as a competitive advantage while at the same time trying to push industry and regulators to
right.
move the whole industry down that path. I mean, it's very interesting when I start talking to guys that have sold annuities their whole life and all of a sudden are go out and get the Series 65 and try to become an investment advisor. I mean, it's just a different culture. And,
sure.
A lot of times conflicts of interest aren't necessarily a good thing or a bad thing. They just are what they are, right? business models, they're not necessarily bad or good. They just are what they are. But when I'm used to talking to investment advisors and just their mindset, and they put a kind of like their code of ethics at the forefront of what they do, they're used to transparency. They're used to disclosing out their other business activities, and they're used to disclosing out their fee arrangements. They're used to, explaining their, like you talked about, your brokerage arrangements with TD Ameritrade, and then you come over to these guys that have been in the insurance world. They're just not used to that. They're used to having very promissory type marketing language, right? And saying, hey, we can guarantee this and guarantee that. And, oh, how much we make, that doesn't really matter. It's not really your concern.
Yeah, it doesn't matter.
Well, I would think that.
It matters.
Yeah.
Well, one of the questions that leads me into, based on your knowledge of the rules and the laws, a broker or a registered representative for a broker-dealer, if they recommend something like penny stocks, what is the maximum commission they could make by law?
That's a good question, and I don't know. I don't know the answer. I don't know off the top of my head. That's something I have to look up,
okay.
And mainly because we're primarily RIA consultants.
Yeah, fair enough.
Fully keep up to speed on that.
Well, maybe
that would be a broker-dealer rule.
Yeah, maybe you can correct me at some point, but my understanding is that if you're selling penny stocks, the maximum commission you can make is limited to 50%.
I don't know.
Okay.
I just don't.
Fair enough. I
Yeah.
respect that answer because I don't want you to make shit up. If you don't know, you don't know. Are there any things that we haven't covered about this whole system that you think maybe my random listeners might want to know?
No, not really. I mean, I think we covered a lot of important things. I think if I just from the things I've seen, the things I've kind of experienced, I would just tell clients, and I get this kind of can be contradictory to what even a lot of my clients' marketing spiel is. There's a lot of people out there that talk about, hey, come to us, we'll be your trusted advisor. We'll handle everything. Let us take care of your finances and your investments, and you go off to retirement and go watch the grandkids and do all that stuff. I think that's great, but I also think that investors still don't want to just completely blindly trust their advisor. And it's almost the same thing that I tell my clients, like Polaris and other firms, that I'm your consultant. You still want to own this stuff. You still want to know where your money's at. You want to understand the different parties that are involved. You want to at least do your due diligence. It's very easy to, people just don't know this. You go out to the FINRA broker check, investment advisor, public disclosure website. There's information out there about your financial professional. There's information out there about your firm. Go out there and look at it. Read the fine print. Make sure you're getting account statements from all your accounts. Make sure you know who your qualified custodian is. If your financial professional is asking you to write a check to his or her firm, and that's not, like in your case, Phil, it's not to a TD Ameritrade where the money should be going, question that. If somebody has sold you annuity, but they want you to write them a check to the financial professional, that should be a red flag. If a financial professional is saying, hey, when you get your statements in the mail, don't look at them, come here and I'll take a look at them first. That's kind of a red flag, right?
Yeah.
There are guys out there that don't always do the most appropriate things. And so you want to, you want to trust them, but verify. You want to know where your money's at, know where your account statements are coming from, know where checks should be written to, and still know that. And
I thought of two more things, if I can jump these in here. Yeah. Someone recently contacted me, and they said that they contacted their current advisor, financial planner, whatever, and asked them, are you a fiduciary? And their response back was, we can be. What do you make of that?
I would make of that is that person is probably duly registered They're both an investment advisor and also as a broker-dealer. And in my mind, right, my perspective, because that person chose to be an investment advisor, he really can't get out of kind of fiduciary duty. So when he's talking to the client, he should be trying to hold himself as much as he can to the fiduciary duty and act as an investment advisor would. However, if that client chooses to not go with a fee-based investment management, investment advisory type service, and instead go with a commission-based broker-dealer registered rep only service, then actually by law, that regime is going to take control, and he would be held to the suitability standards. He'd be held to FINRA standards. If there was a complaint, it'd go through FINRA arbitration, that type of thing. So, and quite honestly, that's where this whole issue of not everybody's a fiduciary just muddies the water and confuses people.
Yeah, I know it does.
A guy like that can say that and is not technically wrong, but you're kind of scratching your head like, well, what does that even mean?
Well, the way I phrase it for people is that ask your financial advisor, consultant person, are you a fiduciary? If they say anything other than yes, then there's a problem there. But maybe I'm overstating the simplicity of it. Another thing we had talked about very briefly, the ADV Part 2A and ADV Part 2B. Does anyone file that specifically that's not an investment advisor?
Nope, that is specifically for investment advisors, serves as the registration document that investment advisor files with regulators. Regulators look it over, comment on it, click their approved, not endorsed, but, approved and filed, and then also serves as a disclosure brochure.
Okay.
And there is not an equivalent document that broker-dealers have to hand out or that insurance agents hand out.
Well, and that's what I was getting to, and I love it when you give answers that I agree with, and I didn't even prompt you. So if someone's listening and wants to know more about their current helper, current advisor, current representative, you could contact them and say, I want a copy, which you should have gotten when you first talked to them. I want a copy of ADV Part 2. And if they say, what is that? Or anything other than, yes, I'll send you one immediately, they're not an investment advisor.
I would agree with that, yes.
Okay.
And even that situation you explained on the guy that said, well, I could be.
Right.
Well, that guy should have an ADV if he could be, but part of his ADV would disclose out and explain how he's also a registered representative of a broker-dealer. Maybe he's also an insurance agent. And so that would kind of, those documents aren't always the easiest to read, but theoretically that would explain out and kind of detail out what the guy does through his investment advisor registration, but also what he would do through other registrations.
Now, a totally randomly different question. If someone wants to get into this industry, could they contact you and you could help guide them through the regulatory and legal and compliance and all that stuff and get set up?
Yes, for sure. So appreciate that. I always tell my friends always joke that the name of our firm, we could come up with a better name. It doesn't make any sense, but I tell them, well, if you're in the industry and you're an investment advisor and you're looking for a compliance consultant, you're going to go Google RIA Compliance Consultants. And that's why we named our firm what it is.
Yeah.
If our website is the name of our firm with some dashes, so RIA-compliance-consultants.com. And like we've talked about, we're a really full service investment advisor consulting firm. So we'll do brand new registrations, and we have literally worked with guys. I remember a guy 10 years ago, 12 years ago, it's been a long time, but he mowed lawns in Minnesota. He literally was in Minnesota and owned a lawn service and had done well in his personal accounts and thought he could just register as an investment advisor. Guys like that, we usually kind of talk them out of it. Right? You really want to jump into this. But point being, We deal with new guys. We deal with all different kinds of business. It's actually very interesting. We've worked with, like I said at the beginning, guys that run a hedge fund, run mutual funds, that are affiliated with broker-dealers, that are not affiliated, we work with firms I've got a client in Singapore. We've got clients in India. We've got clients in Europe. Those are financial professionals that are located outside the U.S., but once you hit a certain number of clients residing in the U.S., you got to get registered with the SEC. So we're not just, U.S. I mean, we are U.S. based, but we're working with clients across the country, all kinds of business models, and now we're working with lots of clients outside the U.S. Our focus is really the investment advisor rules and regs. If you're really interested in learning more about our firm, we have a full marketing department, and we'll do a kind of initial consultation and quote out prices, and we'll work on a fixed fee basis. We also work on an hourly basis. Again, initial registration, policies and procedures, mock regulatory reviews, sample forms, and just general consulting advice, all kinds of stuff.
Yeah, and it's one of those things that when I first started using you guys, because I had done it for a long time by myself, it seemed like a lot of money, but now it seems like, don't tell your bosses, you probably should charge more, and I know your rates have gone up because things keep getting more complicated. And I know we're going really long, so if you have to leave at any time, let me know, but just popped another thing into my head. Recent changes on due diligence rules. Any comment on that? I know it's brand new.
Well, the due diligence stuff, in the investment advisor world, another big difference between investment advisors and kind of the broker-dealer world is the broker-dealer world, because they're not held to a fiduciary standard, more that suitability standard, there's a lot more what I'd call black and white, real specific rule requirements. The investment advisor community, it's more principles based. And this idea of due diligence and this idea of other things, cybersecurity, information security, customer privacy, identity theft, those are a lot of things that are definitely hot topics in the investment advisor compliance world. But there's not been necessarily a lot of hard, fast rules that have come out. So we've been kind of on top of due diligence, both at not just the investment perspective. If an investment advisor is out there looking at investment offerings, investment products for clients, clearly you got to do your research, due diligence, look at performance, but also even things like vendor due diligence. I'd tell you, Phil, you're using TD Ameritrade, and ask, why are you using TD Ameritrade? How have you picked them? Are they in the client's best interest? What kind of due diligence have you done? Even though that's a big firm that everybody probably knows about, still doing your due diligence and kind of proving up how you're picking third-party vendors, how you're picking relationships, different, then we could go on for this, but just different, and regulars will come in and want to know, like, what's your policy on it? What kind of documentation are you keeping it? Are you really doing that? And so anyway, that's been something that we've seen and we'll continue to see, and that's something that we see get brought up by both the SEC and state regulators during exams.
Great. Well, Jarrod, thank you so much for your time. I really do expect my listeners are going to love this incredibly detailed look at some of the regulations and some of the stuff kind of behind the scenes. I appreciate your time very much.
Sure, no problem. I appreciate you having me.
You're listening to The Phil Ferguson Show.
All right, we've come to that part of the show where it's time to wrap up. Hopefully you enjoyed the interview. A couple of things real quick about me. I'm planning on going to CSI Con. I think it's CSI Con. Yeah, CSI Con put on by CFI in Las Vegas. I think that is mid-October-ish. I'll have to double check. We've got some time. And the FFRF convention, I think, follows that a few weeks later in San Francisco. So I get to go to Vegas and San Francisco. If you're anywhere on the West Coast or you want to fly to the West Coast, I'd be happy for you to say hello if you show up at one of those conferences. To the best of my knowledge, I only have one review here. It's a 5-star review on Apple iTunes. And of course, if you like the show, the two things that I ask that you do is that you either give me a 5-star review, if that's the best you can do and you don't have funds and you just want to say that you learned something. A 5-star review on iTunes or Stitcher is fantastic, and I always appreciate that. Or you can donate to a charity of your choice. It doesn't have to be secular, but that's kind of my motivation. So, the Secular Student Alliance or American Atheists are two that I give to on a regular basis. And I have some more matches and challenges coming up. Maybe you want to wait for that, but you can go donate some money. You don't have to put my name on it. Some people have done that. Thank you. You can leave your name on it, but if you want to, if they allow for comments, say that you put it because of the Phil Ferguson Show. So here's the one review on iTunes from Karma1207. Quote, I came for the atheism and stayed for the financial advice and entertainment. I've learned so much from Phil's show and been a very satisfied customer for a while now. I went from being someone who kind of picked mutual funds at random with no understanding of the pros and cons of what particular fund or the possible hidden costs involved to someone who knows why my investments, to someone who knows what my investments are, what those investments are intended to do, and about resources I can use to learn more or verify what I've been told. It's nice to hear from someone providing information and advice designed to benefit investors and folks saving for retirement rather than listening to salespeople who might be out to enrich themselves and the big obfuscating. Oh, you got to put easier words for me to read. Obfuscating. Anyway, I'm going to move on. I'm tired. Investing companies that employ them, sometimes at the investor's expense. Whew, that was a long one. Thank you. Thank you very much for the kind words. I greatly appreciate it. Maybe I should have read that a couple more times before I read it out loud. Got big words in there for me. But I'm going to wrap up. Thank you for listening to the show. Thank you for sharing the show with your friends. And thank you to everyone that saw me on Atheist Experience and has sent so many kind emails and messages about being on that show. I greatly appreciate it. I do hope to see you somewhere soon. Until then, ciao.